Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine looking at a stock chart for, one of the most dominant tech companies on the entire planet.
Right.
And you just see this sheer cliff face. I mean, the stock has plummeted roughly 23% year to date.
Yeah, it's been brutal.
It fell from this late 2025 high of, near $490, all the way down into this $370 to $384 range.
Which is a massive haircut.
Exactly. And, if you were just glancing at your portfolio, your immediate instinct would be that the core business is just unraveling, like something is structurally broken.
Right, because that's what conventional wisdom tells you, right? When you witness a drop of that magnitude on a mega cap tech stock, the assumption is always the growth story is over.
Yeah, that they're losing customers or margins are tanking.
Or that some competitor just completely ate their lunch.
Yeah.
And this is where it gets really interesting. When we actually look at the data from their fiscal second quarter of 2026.
The one that ended in December 2025.
Right, exactly.
Yeah.
When you look at that quarter, we see the exact opposite. I mean, it wasn't just resilient, it was a blowout of historic proportions.
Yeah, let's put some scale to that blowout, because honestly, these numbers are almost difficult to comprehend when you read them.
They really are.
We are talking about total revenue hitting $81.3 billion for a single quarter.
Insane.
That is a 17% increase year over year. And crucially here, this isn't just top-line fluff where they're, spending $2 just to make $1.
Oh, absolutely not.
This is highly profitable growth. I mean, adjusted earnings came in at $4.14 per share. That's a 24% bump.
Yeah, their profit engine is just running incredibly hot right now.
Yep.
And to really understand why that is, you have to look inside the intelligent cloud segment, because that division alone reached $32.9 billion in revenue, up 29%. And within that, this is the crazy part, the Azure platform specifically surged by 39%.
Okay, that 39% figure is the one that really stood out to me, especially when you isolate the AI component of that.
Yeah, the AI attribution is wild.
Because the data shows that Azure AI services alone drove 13 to 16 percentage points of that total cloud growth.
Which is a huge chunk.
It is. And it tells me that we've crossed this massive threshold. Like, artificial intelligence is no longer this theoretical buzzword.
Right. It's not just a research project anymore.
Exactly. It is literally printing billions of dollars of recognizable revenue right now, today.
Yeah, the monetization phase is entirely real. I mean, we are seeing the return on investment materialize on the income statement right in front of us, not in some, hazy 2030 forecast.
Which brings us to the ultimate paradox of this whole situation.
The great disconnect.
Right. Because if you have a company generating over $80 billion in 90 days, with earnings up 24%, and their flagship product expanding at nearly 40%,
Yeah.
why is the broader market punishing the stock so severely? I mean, Wall Street doesn't usually sell off a 24% earnings bump.
No, they usually reward it.
So there has to be some terrifying, hidden cost somewhere that has investors completely spooked.
No, there is. And the market is hyper-fixated on the bill.
The CapEx.
Exactly. The capital expenditure required to fund what the industry is calling these AI superfactories.
Which sounds incredibly expensive just saying it.
Oh, it is. The primary bear case right now revolves around the sheer eye-watering scale of their CapEx.
Yeah.
In that same blockbuster quarter we just talked about, the company spent a record $37.5 billion
Wow.
just to build data centers, procure advanced GPUs, and secure the power grids to run them.
$37.5 billion in one quarter. I mean, if you annualize that, you are looking at over $148 billion in capital expenditures for the year.
Which is higher than the GDP of a lot of sovereign nations.
It's absurd. And, for investors who are accustomed to software companies operating with these asset-light, super high-margin models.
Right, where your biggest expenses like office snacks
Yeah.
and engineer salaries.
Yeah. Seeing a hardware bill of $148 billion has to feel like walking onto a completely different planet.
It fundamentally breaks how traditional analysts model the stock. I mean, they're looking at a software giant suddenly taking on the capital intensity of an oil company or a massive energy utility.
But And this is where I think the market has it wrong. Let's look at what that money is actually buying.
Okay.
Because when I see that 37.5 billion quarterly capex, I don't see a company just setting cash on fire.
No, not at all.
I think about the building of the Transcontinental Railroad back in the 1860s.
Oh, that's a great analogy.
Right. Because at the time, blasting through mountains and laying thousands of miles of iron track, it required a staggering, once-in-a-generation upfront cost.
And people thought it was financial ruin.
Exactly. On paper, it looked terrible. But the strategy wasn't about the cost of the iron, it was about grabbing the land. Because once those tracks are laid, you own the route.
And everyone has to pay you.
Every ounce of commerce moving across the country has to pay you a toll. And that feels exactly like what we were watching here. These AI sucker factories are the digital tracks for the next century of commerce.
Yeah, that analogy holds up perfectly when you look at the underlying financial foundation supporting this whole build-out.
Because they can actually afford it.
Exactly.
Right.
What mitigates the panic over that 148 billion annual run rate is the reality of their balance sheet. I mean, it's an absolute fortress.
Right.
Even while writing those massive checks for data centers, they generated $35.6 billion in quarterly operating cash flow.
So they essentially paid for it with cash generated in the same quarter.
Pretty much. Plus, they're maintaining over $80 billion in cash and equivalents. And their free cash flow margin is sitting at a remarkably healthy 20%.
Meaning they are building the most expensive infrastructure in human history, totally out of pocket, and they still have billions left over.
Yeah, they do.
Because, I mean, the data shows they returned $12.7 billion to shareholders through dividends and buybacks in that second quarter alone.
Right. And that cash generation isn't just a backward-looking metric. It's highly visible moving forward, which brings us to a metric that, frankly, completely dismantles this immediate cash flow risk.
Okay, what is it?
It's called RPO, or Commercial Remaining Performance Obligations.
Okay.
That specific metric surged 110% year over year. It created this massive $625 billion backlog.
Whoa. Let's pause and unpack that RPO, because $625 billion is an astronomical figure to just have, sitting in a backlog. How solid is that number? I mean, is that just a projection of what the sales team hopes to close, or is that legally binding?
Oh, it is totally legally binding.
Why?
RPO represents contracts that customers have already signed for future services.
Yeah.
The revenue just hasn't been recognized on the income statement yet because, well, the service hasn't been fully delivered.
Right, accounting rules.
Exactly. So think of a Fortune 500 company signing a 5-year, multi-billion-dollar commitment to use the Azure cloud. That money is locked in.
Got it.
So for an investor, a $625 billion RPO is the ultimate sleep well at night indicator.
Because you know the cash is coming.
Right. It completely de-risks the near-term profile. It gives you absolute mathematical certainty that the money will come through the door to cover the costs of all those super factory investments.
So the financial bedrock is absolutely there. They have the cash, and they have this massive guaranteed future revenue.
Yep.
Let's shift gears and look at the actual product evolution, because the business model itself is undergoing this fascinating shift right now.
It really is.
We are moving away from the traditional, per-seat software licensing model where a company pays a flat monthly fee for a word processor, and we're shifting toward this high-margin agentic AI consumption model.
Right.
What does that transition actually look like on the ground for a business?
Well, it represents a shift from selling a static tool to selling a dynamic digital employee.
Okay.
Under the old model, you bought a spreadsheet application. It only worked when a human was actively clicking the buttons. But under the agentic model, you are paying for autonomous agents that just work in the background.
Yeah, the data points out this Wave 3 agentic AI rollout, which apparently pushed their Copilot product to over 15 million paid seats.
This is huge.
Generating $5.4 billion in annual recurring revenue. And they are embedding these autonomous agents directly into Teams, Outlook, Dynamics 365.
Right, exactly where people already work.
So instead of me having to open an app to schedule a meeting, the AI is just sitting in my inbox. It's reading a complex email chain from a European client, understanding the time zones, cross-referencing my CRM.
And drafting the reply.
Exactly. Drafting a reply and scheduling the follow-up automatically.
And because it is embedded into the core workflow applications that enterprises already use, it creates this immense ecosystem lock-in.
Right.
You don't have to train your staff on a new third-party platform. The AI is simply injected right into the tools they've used for 20 years. But, and this is a big but bird, to achieve that level of autonomy, you have to overcome the single biggest hurdle in enterprise technology.
Which is security. Because
Exactly.
if I have an autonomous bot reading highly confidential financial data and firing off emails, I mean, the potential for a catastrophic data leak is huge.
Oh, it's a nightmare scenario for any IT department.
So how are they actually securing this?
Through a system called Microsoft Entra Agent ID. And honestly, this is perhaps their most underappreciated strategic advantage right now.
Okay, how does it work?
Entra Agent ID basically assigns a verified, cryptographically secure digital identity to every single autonomous AI agent operating within a company's network.
So it gets an ID badge.
Exactly.
Yeah.
It applies the exact same strict identity verification access controls to a piece of code that it would to a human employee.
So if an AI agent is trying to pull data from an HR database to build a report, the system physically checks the agent's ID badge, so to speak, to see if it actually has clearance for those specific files.
Precisely. And that acts as a massive regulatory moat.
I see.
Because imagine you are a brilliant, super well-funded AI startup. You might build an algorithm that is marginally faster or smarter,
Sure.
but a Fortune 500 bank or a major healthcare provider is never going to let your unverified rogue AI loose in their proprietary data.
No way.
They demand enterprise-grade compliance, governance, identity verification, infrastructure that takes decades to build and integrate. They will only trust a system like Entra Agent ID.
That regulatory moat makes total sense. But I want to pivot to something that seems like a massive vulnerability here.
Okay, what's that?
The crown jewel of this entire AI strategy has undoubtedly been their partnership with OpenAI.
Right.
Yet recently, we are seeing all these headlines about OpenAI forming partnerships with competitors. Amazon, Oracle.
Yeah, that's caused a lot of noise.
If I'm holding this stock, I'm looking at those headlines, and I'm wondering if the supposed monopoly is already leaking. Like, are they losing their exclusive grip on the most critical AI models in the world?
It is the most common fear in the market right now, but it really stems from a fundamental misunderstanding of how the partnership was restructured.
Really?
Yeah, the leadership didn't just passively sit back and hope OpenAI would remain loyal. They restructured the deal. They took a 27% equity stake in OpenAI.
Okay.
But far more importantly, they locked in an exclusive 10-year, $250 billion Azure Services contract.
Wait, 250 billion?
Yep. And they secured long-term intellectual property rights stretching all the way through 2032.
Okay, walk me through the mechanics of that. Because if a client accesses an OpenAI model through, say, an Oracle platform,
Right.
how does that Azure Services contract actually protect the original investment? Doesn't Oracle get the win there?
Not really, because it effectively commoditizes the competitor's platform.
How so?
Because of that 10-year contract, the underlying compute architecture required to train and run those OpenAI models is inextricably intertwined with Azure.
Ah.
So even if the end-user interface happens on a rival platform, the heavy lifting, the actual compute cycles, happens on Azure infrastructure.
Oh, wow.
Yeah, they have positioned Azure as the foundational compute toll road. Whether a customer uses a proprietary model, an open source model, or accesses it through a third party, they're still paying the toll to run the compute.
So they win the infrastructure game regardless of who wins the app game.
Exactly.
That is a brilliantly devious hedge. But clearly that nuance is totally lost on the broader market because the psychological state of investors right now is incredibly grim.
Oh, it's terrible.
We are looking at a classic wall of worry. I mean, BNP Paribas recently put out a rather blunt, bearish note regarding that 17% year-to-date decline,
Right.
highlighting that it's the worst quarterly showing for the stock since 2008.
Yeah, and market sentiment often completely disconnects from the underlying data.
Really?
When technical indicators flash red, institutional and retail fear can compound so quickly, and it just overshadows the kind of structural advantages we just spent 10 minutes discussing.
And to make matters worse, the fear isn't just coming from outside analysts looking at charts. There is major internal drama making the rounds.
The code red.
Yes. CEO Satya Nadella reportedly called a co-pilot code red to completely overhaul the product's performance. And explicitly because they are feeling intense competitive pressure from rivals like Anthropic. Add to that a really contrarian warning. Recent data shows 31 insider trading transactions trending net negative.
Yeah.
So, if you look at the CEO calling a literal code red and corporate insiders quietly selling off their own shares, the natural instinct is to run for the exits.
Of course it is, but we have to separate the signal from the noise here.
Okay, let's separate.
Let's examine the code red first. In the context of a highly aggressive, mega cap tech giant, a code red initiated by someone like Nadella is rarely an indicator of panic or a failing business.
What is it then?
It is a tool for proactive management intervention. Anthropic released a highly capable model, and rather than just resting on their laurels, the leadership team used a code red to aggressively rally their engineering divisions.
So it's basically a motivational tool.
Exactly. It forces the company to break down internal silos and accelerate development ahead of major product launches. It's evidence of a hyper-competitive, almost paranoid leadership culture, which honestly is exactly what you want as an investor.
Okay, that reframes the internal culture. I can buy that. But what about the 31 net negative insider transactions? That feels a lot harder to dismiss as just, proactive management.
I get that. But insider selling is a notoriously noisy signal.
Really?
Yeah, executives sell stock for a myriad of mundane reasons, covering tax obligations from vested options, buying real estate, or just basic portfolio diversification.
True. They have lives to pay for.
Exactly. It rarely means the ship is sinking. A much stronger signal is institutional flow, what the absolute largest pools of capital in the world are actually doing.
And what are they doing?
Well, there, the story flips completely. Institutional giants like BlackRock and Vanguard actually increased their weightings in late 2025.
Wait, really? So the retail investors are getting spooked by the headlines and selling, while the colossal asset managers are quietly buying the dip.
Spot on. They are treating it as the safest possible bet within a highly volatile, highly speculative AI sector.
Makes sense.
And, the people actually writing the checks for the software agree with that assessment.
The customers.
Right. A recent KeyBank survey of enterprise IT executives revealed that 85% of them plan to increase their spending on Azure in the coming year.
85%.
The customers are leaning in, not pulling back. And that's exactly why, out of 58 major analysts covering the stock, 55 still maintain a buy or strong buy rating.
55 out of 58.
Yep, with a consensus price target of $587.31.
So from the current trading range, a $587 target implies roughly 58% upside.
Which is massive.
On a company of this size, a 58% move is seismic, which means we need to look at actionable timelines. I mean, fundamentals eventually win, but what forces the market to wake up?
Right, the catalysts.
If we analyze the technical indicators, the research suggests a capitulation bottom is finally forming. The stock recently bounced 15% from its late March lows and seems to have established a very solid floor of support around the $356 mark.
Yeah, the technical damage was undeniably severe, but the structural repair is definitely underway. And one of the key indicators here is the MCD, or moving average convergence divergence.
Okay, for those of us who don't spend our days reading candlestick charts, what does the MaxLend actually track, and why does it matter right here?
Sure. In plain terms, the MaxLend measures the momentum of a stock by comparing its short-term price trend to its long-term price trend.
Okay.
Earlier in the year, the stock experienced a death cross, which sounds super dramatic, but it simply means the short-term average dropped below the long-term average. It indicates strong downward momentum.
Like a heavy rock rolling downhill.
Or think of a massive ship turning in the wrong direction. But what we are seeing now is that the MaxLend has turned slightly constructive. The downward momentum is exhausting itself, and the ship is beginning to slowly turn back around.
And while that momentum turns, the valuation itself has become incredibly compelling.
Oh, completely.
I mean, the stock's trailing price-to-earnings ratio is currently sitting around 23x. That is a multiple we have not seen since the early 2020s.
Well before the generative AI boom even began.
Exactly.
And this is perhaps the most critical takeaway for anyone analyzing this situation. The valuation compression is fully priced in.
Right.
Acquiring shares of a company leading the global AI infrastructure build-out, backed by a $625 billion guaranteed revenue backlog at early 2020s valuation of multiples, It's a historical anomaly.
You are effectively getting the entire generative AI growth engine for free, just based on historical pricing models.
Precisely.
So the setup is there.
I know.
Now, what are the specific triggers on the Catalyst calendar over the next 3 months that could force this re-rating?
We have a few big ones.
First up is the earnings call on April 29, 2026. The consensus EPS expectation is $4.07 on $81.38 billion in revenue.
Which they are positioned to beat.
Right. But the crucial metric to watch here is Azure's growth rate. If they can demonstrate that Azure is stabilizing anywhere above 37%, the narrative that cloud growth is decelerating just gets destroyed.
Yeah.
And we could see a massive short covering rally.
The market is desperate for confirmation of durable cloud growth. An upside surprise on April 29th would violently shift the sentiment away from the CapEx fears and back toward the revenue reality.
Then just 2 days later, on May 1st, 2026, we have the highly anticipated E7 product launch.
This is huge.
The rumors indicate this is going to be the first fully Asian integrated operating system. We are talking about an OS where the AI isn't, just an application you launch.
Right.
It's the core fabric of how you interact with the computer itself.
And that E7 launch perfectly explains why Nadella initiated the code red earlier in the year.
Ah, of course.
Right. They were clearing the runway to ensure a flawless, highly optimized rollout for a product that fundamentally redefines enterprise computing.
But the catalyst that truly illustrates their dominance happens a few months later, on July 1st, 2026.
The price hikes.
Yes, they are implementing massive 8 to 13% price increases across their M365, E3, and E5 enterprise plans.
Which is wild in this economy.
Think about the broader economic environment right now. In a period of high uncertainty, a company that can raise prices on its core product by double digits without sparking a mass exodus of customers.
They possess the ultimate business superpower.
Extreme pricing power. Every extra dollar from that 13% hike flows directly to the bottom line as pure profit.
It is the ultimate flex of their ecosystem lock-in. And, this is all happening against a shifting macroeconomic backdrop.
Right.
The broader software sector just experienced its best week in 25 years. We are seeing capital aggressively rotate back into high-quality, cash-generating tech names as the Federal Reserve signaled potential rate cuts.
So the macro environment is perfectly primed to support a rally.
Exactly.
Let's distill all of this down to the core investment thesis. Based on all the data, we are looking at a bullish score of 8 out of 10.
Yeah, that feels very accurate.
The target horizon here is not a quick day trade. It is a multi-year hold, roughly 12 to 18 months. You hold this to capture the full return on investment cycle from the agentic AI rollout.
Right.
And you hold it to watch that massive $625 billion RPO backlog officially convert into recognized revenue on the income statement.
So the overarching summary is quite clear. The broader market is aggressively pricing in an AI winter due to CapEx fears.
Right.
But the underlying fundamentals, the unprecedented cash flow, the deep customer lock-in, the brilliant restructuring of the OpenAI partnership, and the massive compute infrastructure, all of it confirms the existence of a durable AI monopoly.
An AI monopoly. That is a powerful concept. And as we wrap up, I want to leave you with one final, slightly provocative thought to consider.
Okay.
Throughout this entire talk, we focused heavily on digital software, cloud compute, and digital agents living inside your inbox.
Very screen-based stuff.
Exactly.
Yeah.
But there are unconfirmed rumors floating around the industry regarding that Agent ID security system we discussed earlier.
Oh, wow. Yeah.
The rumors suggest they are actively looking to expand Agent ID beyond purely digital bots, pushing it into the realm of industrial robotics.
That's fast.
They want to unify digital AI agents with physical, real-world robots under one secure identity and governance framework.
Wow.
So, if this software ecosystem successfully manages to unify the digital world with the future of physical human labor, are we even analyzing a traditional software company anymore?
That's a great question.
Or are we looking at the underlying operating system for the physical economy itself? Take some time to think about the implications of that. Until next time.